I have been covering some of the best dividend ETFs for maximizing income generation. But on top of that, I also cover various ETF combinations that, in my opinion, can create a very powerful all-around portfolio that not only generates a consistent source of income, but also incorporates powerful investing strategies to help maximize growth potential and minimize downside risk. And I like to focus on the typical growth and value combination. However, by screening for ETFs that are able to maximize income generation through option strategies, in my opinion, helps enhance portfolio performance in the long term. This is especially relevant now as the markets are experiencing heightened volatility and many investors are shifting towards safe haven assets, which has led to a strong performance in dividend ETFs. So the question is, how can you find the best dividend ETFs to create an all-around dividend portfolio for yourself and your goals? And what strategies do I use to come up with these dividend ETF combos? In this video, I want to break down in detail how I personally screen for specific dividend ETFs, what characteristics are especially important to consider, and how to find the best performing high income option strategy ETFs to complement your portfolio. Now, towards the end of the video, I will also share a series of new, very powerful 2 ETF combos that, in my opinion, offer some of the strongest market exposures while delivering a very high average dividend yield of 6 to 8%. So make sure you guys stick around until the end because I got some juicy information coming. Now, I'm going to be using the comparison tools, charts, ETF screeners, and ETF deep dives, all from the Seeking Alpha platform. And right now they are running their Black Friday sale with 20% off site-wide on Seeking Alpha. That includes $60 off their annual premium plan, plus savings of over $220 on the Premium and Alpha Picks bundle, and $480 off their Pro Quant portfolio. I highly suggest to take advantage of the Black Friday sale before it ends. You can use my link in the comment section or description down below. And a huge thank you to Seeking Alpha for sponsoring this video. So to begin, what are the primary screeners that investors should use to filter out the best dividend ETFs? The first is obviously dividend yield. You want an ETF that can produce a strong dividend yield and serve as a source of income and stability. But you have to be careful. And while any company with steady earnings and cash flow can pay a dividend, the key is whether they can sustain and consistently grow their dividend distributions. And this brings us to our second key criteria, which is dividend growth. Dividend growth is one of the most important factors when selecting a strong dividend ETF. Companies that consistently increase their dividends tend to have very efficient operations with strong and growing earnings and reliable cash flow. Powerful dividend growth ETFs also provide strong appreciation over time. The best and most common screening method for dividend ETFs is to look for 3 and 5 years of dividend growth. Now, the next 4 screeners are asset allocation, diversification, assets under management, and expenses. First, you want to make sure that you have an ETF with a low expense ratio so that it doesn't eat into your total returns over time. Next, you want to make sure that these dividend ETFs have high assets under management, simply because it tells you that they are more reputable and favorable amongst other investors. Plus, they have high levels of liquidity. And high liquidity is crucial because it allows you to trade in and out of ETFs without incurring heavy transaction fees. But more importantly, it is crucial to find ETFs that are diversified and are primarily focused within the large cap sector. Large cap stocks, whether they are growth or value stocks, are the primary focus for long-term dividend investors because they offer the most stability and reliability. Now, the last step is to screen for high income ETFs, and these fall under a category known as derivative income. In this context, derivative income simply refers to ETFs that generate income using option strategies. And screening for those is a little bit more complicated, but I'll show you my 2 primary strategies in just a second. So the first thing I do is click on ETF Screener, which is located on the left side under the Find and Compare section. Click on Create New Screen, and the first filter I'm going to add is under the ETF Details category. Then click Asset Class and Subclass as a filter. And once I click Done, I click on Edit Filters and choose Large Value US Equity, Large Growth, and Large Blend. And what this does is it filters all the ETFs that focus on large cap stocks. And immediately you have exposure to over 400 different ETFs. Contrary to most investors who will immediately screen for dividend yield, I like to start with dividend growth because, like I said, it is a stronger indication of the reliability and strength of a dividend ETF. And you can specifically screen for dividend growth by clicking on Advanced Filters, Dividends, and clicking on Dividend Growth 3-year or Dividend Growth 5-year. And right here, you have these bars that allow you to adjust the dividend growth rate. But it's important to keep in mind that there are many dividend ETFs that have been released that are less than 5 years old, so you won't be able to find them. And if you're looking for newer ETFs with high potential, then you have to be mindful of this. Now, the next filter to use is dividend yield. And once again, we repeat the same process, but this time we click on dividends and then on dividend yield TTM. And this represents the trailing 12-month dividend yield of the fund. And most dividend ETFs will have yields greater than the average yield of the S&P 500, which currently sits at 1%. In my opinion, once a fund reaches a 2% yield, this is when their asset allocation leans more towards value with a focus on stability. And the higher the yield, the less appreciation the fund will have. This trade-off is very common. Now, I know what you're thinking, 2% is practically nothing as an income source. However, remember that we are also going to be screening for high income ETFs to complement these ETFs. My strategy is to combine dividend ETFs with high income ETFs so that you don't have to screen for extremely high dividend yields that could hinder your portfolio's growth. However, the next step that I like to use is focus on their dividend score. And the primary reason for this is to find ETFs that have the healthiest overall dividend grade and the lowest probability of cutting their dividends. The C- score is where I draw the line because anything below that showcases that the fund is not able to provide consistent dividends and dividend growth. So we have filtered out over 380 different ETFs, and now we have a list of some of the strongest performing dividend ETFs in the market, such as SCHD, DGRO, DVY, VYM, and DIVB, which I haven't talked about before, so stay tuned for that one. And now we also want to add a screener for high income ETFs, but in order to do that, we have to create a separate screener. And the first thing to click on is under asset class and subclass, and that is derivative income. Here you will find a list of high income ETFs. And what I like to do here is first organize the ETFs based on assets under management. And right at the top, you will find the most popular dividend ETFs, JEPI and JEPQ. But as you scroll down, you will find very prominent and powerful ETFs like DIVO, which I'll be covering soon, SPYI, QQQI, GPIQ, BALI, and the list goes on. And I find that the best way to filter these ETFs is through their holding breakdown. I've always preferred high income ETFs that are more diversified, because I find that high income ETFs that are on too few stocks or even on single stocks like the Yield Max funds carry a lot more risk and volatility, and therefore it defeats the entire purpose of complementing a portfolio with high income for stability. So by clicking on these individual ETFs and analyzing their holding breakdown, which you'll find by simply clicking on holdings, the more diverse these ETFs are, in my opinion, the better they are. And this is how you can complement the dividend ETFs that you find with specific high income ETFs based on their holding breakdown. You can simply use the fund overlap tool and look for ETF combinations that have under 30% overlap. Now, the second step that I take is I look at their yield on cost charts. And this is a graphical representation of the ETF's trend in dividend yield, dividend growth, and net asset value. Now, I've explained this before, but the rule of thumb is that if this chart is trending upwards or flat from left to right, then you have a great and strong high income ETF. But if it is trending downwards, then you likely have a dividend trap. And the steeper the slope, the worse it is. Simple. For example, one very powerful ETF combo that I've talked about before is SCHD and JEPQ. And when you compare their holdings breakdown, you'll find that JEPQ is heavily growth-oriented, while SCHD is primarily value-oriented. So these two serve as a very strong complement. Plus, their yield on cost charts are trending upwards. ETFs like JEPI and DGRW can also be a very strong ETF combo because one provides value exposure with a high income strategy, while the other has exposure to both value and growth. But in my opinion, a very powerful two ETF combo is QDVO and DIVO. These two ETFs complement each other extremely well, but the best part is that both of them use a high income strategy, where one is primarily focused on the value sector, while the other is focused on the growth sector. The key here is that DIVO can be compared to a dividend ETF like SCHD. And what I love about it is that it combines the dividend yield of its underlying assets with a covered call strategy in order to provide a dividend yield of around 5%. So the fund isn't necessarily searching for stocks with the highest dividend yield because, as I said, that can inhibit total growth. Its covered call strategy is minimizing volatility similar to SCHD. in fact, even better. But at the same time, it is exhibiting similar total returns because of its asset allocation. And QDVO exhibits powerful growth potential and has outperformed the S&P 500 and the QQQ since inception. The ETF puts an emphasis on large cap growth stocks, but adds an active management approach to find and filter stocks that exhibit strong earnings growth and strong free cash flow. This gives it a quality tilt, which is then combined with a tactical covered call strategy for high income, just like Devo. Now, you could also pair QDVO with a dividend ETF like FDVV or DGRO, where you get strong income from QDVO, but also qualified dividends from FDVV, while exhibiting strong upside growth potential and with risk management characteristics on both ends. Using the most recent inception date, you can see that both combinations have heavily outperformed the S&P 500, minimizing downside risk and capitalizing on upside potential. Now, I will be doing a deep dive into these ETF combos, so definitely stay tuned for that. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit that thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one. Bye! This video is for educational and entertainment purposes only and is not financial, investment, tax, or legal advice. Discussions of ETFs, investing strategies, market updates, or specific funds are general, not tailored to your financial situation, and should not be relied upon for decision making. Investing involves significant risks, including total loss of principal, and past performance does not guarantee future results. I am not a registered financial advisor. My content reflects personal research and publicly available information. I may earn affiliate commissions from mentioned products or links disclosed per FTC guidelines, but these do not influence my opinions. Always consult a licensed financial professional and verify information independently. By watching this, you agree I am not liable for any losses or consequences from your actions. International viewers should consult local regulations.